Hi, it's Neil Frankel. Welcome to the 2013 State of the Market Address. Today we'll spend about 30 minutes. We're going to go through what's happening in the stock market, what's happening in the economy, where the opportunities, where the challenges, what you might expect in 2013 and going forward. Of course, it's impossible to really know. But we'll have a very broad overview and a lot of interesting information. As a matter of fact, when I was putting this together myself, I was very surprised by what I found. And I think that you're going to be surprised as we discuss many of the issues in the economy and the overall strengths and weaknesses. Some of this will not be a surprise, but much of it will be. And I recommend that you take very good notes. And you can obviously shoot me an email with any questions you have or give me a ring. Now, I talked to your neighbors, and they asked me to tell you that they want you to give this, take a lot of notes so that you can present the material to them next week. Now, if you're unwilling to do that, just send them this link and have them watch the presentation yourself. Not a problem. So, let's get started on the 2013 State of the Markets. It's very important to have perspective on the economy and the market, because we have our own preconceived notions. And I'm going to ask you for the next 30 minutes to leave your preconceived notions here in this black box. And let's just go on and look at things with a clean slate and open mind, because there's a lot of interesting information, in my opinion. Now, the last 15 years, investing in the stock market hasn't been easy. As you can see, it's been a very wild ride. Make a lot of money, lose a lot of money, make a lot of money. It's been crazy. Now that's not to say that you can't make money over time in the stock market. You absolutely can. And towards the end of the presentation, I'm going to show you what we do to counteract this extreme volatility. But the takeaways are, number one, probably it's reasonable to expect that this extreme volatility in the stock market is going to continue. It's not going away. Number two, you can still make money in the market. Now, what's key in understanding what's going on in the stock market is looking at the PE ratio. So you can see at different times, when the market was low, there was a PE ratio of 14. When the market was high, it was 12. What exactly is this PE ratio, and why is it so important? Okay, let's say you have a stock that's selling on the market at $100 a share, and it's earning $50 a share every year. Now, that's not to say that it's paying out $50 in dividends, but let's say the profits were $50 a share. That's what the company was earning. It either pays out dividends or reinvests, or a combination of that. So the PE ratio there is 2. In other words, it takes 2 years for the company to earn enough to pay for itself. That's considered pretty cheap. What if you have a stock that's going for $100, but the earnings are only $5? What's the PE ratio there? Well, if you said 20, you would be right. And that means it would take 20 years of earnings to pay for that stock, which means there's a lot more risk in this second stock, a lot more risk. Now, what influences the PE ratio? You can see that as the PE ratio goes up, there's more risk in the stock. What influences that? Now, there are 2 things. Number one, it's the overall market. If everyone's super optimistic and willing and thinking the stock market's going to go up to the moon, then prices get bid up, stocks get expensive, and the PE ratio gets climbs. If, on the other hand, stocks are cheap because everyone's depressed, the market has just caved in, and there's been overreaction to the weakness in the market, then you're going to see PE ratio drop. Likewise, if people get extremely optimistic about a stock or pessimistic, that will make the PE ratio either go up or down. So it's the market and the individual stock that drives the PE ratio. Now, let's see how important that is. Let's look at a stock. The top one here. Let's say it's earning $112 a share. And the PE ratio happens to be 12 at this time. Well, if we multiply 112 times 12, the value of that stock is $1,344. as you can see. Okay. And you have my really crazy swiveling arrow to prove it. If the earnings go up a little bit and the PE ratio stays the same, the value goes up also. Goes up to $1,500 if the earnings go up but the PE ratio stays the same. If the earnings stay at 112 but the multiple goes up to 14 because people are very optimistic about either the stock market or this individual company, then the value of that stock goes up, as you can see. And finally, if you hit the lottery and the earnings go up and the multiple goes up because the market's either optimistic or they're optimistic about the stock, then the value goes up. And you can see how quickly your stocks can rise in value if the earnings or the multiple go up or both. So now your stock may or may not reflect the value at any one time, but over a long period of time, the earnings times the multiple works, and it's a very important statistic to view. Now, are stocks expensive now? Here's a graph that shows what's been happening to the PE ratio since before 1994, and you can see in 2000 it was crazy. The average PE ratio was over 16. Excuse me, the average has been 16 since 1994, but in the year 2000 and right around there, it was actually over 25. So the average is 16 and it was up to 25. That means people were super overly optimistic, and we all know what happened in the year 2000. Likewise, after the market caved in 08, the PE ratio dropped below 12. Right now we're at 12.5, and that's below the average, but I like looking at a PE ratio of 12, and that gives you just a rough idea, even though the average of 16 I think is overinflated because it was very high, artificially high, in the, since from 98 to 2001. But 12 is probably a fair number of where we've been if you were to exclude that that period of time when it was very frothy. Okay, now so we're at 12.5 right now, and the earnings, if we look at the earnings, we can see the company's earnings for the most part have been going up as well. Now again, during 08 and 09 the earnings dropped because we had that recession, and but earnings since then have been climbing, and basically earnings have been climbing since the 70s, as you'll see in a minute, because the technology and productivity of companies has been very good, has been improving. So earnings continues to rise. Let's look and see how strong are corporations right now. Well, if we look at their cash, we can see that cash as a percentage of their current assets has been rising. That means companies have a lot more money, unlike the government. They have money on the books, cash in their pockets. So this is great because companies can afford to expand when they want to. They don't have to pay for interest expense, and they have a lot of ability to invest in their own businesses. So this is a very big positive. So we've seen how much cash companies have on hand, and it looks pretty impressive. They got more cash than ever, just about. Let's look at their expenses now on their debt, on the debt side, and we can see that the average debt has really fallen. The average debt held by corporations. So again, unlike government, corporate debt has really fallen, and the debt expense has gone down. So what this means is that corporations are pretty strong. They got a lot of cash, and they don't have a lot of interest expense to pay. So that gives them the ability to be very agile and invest when the opportunity presents itself. And you'd have to conclude, based on the last two slides, that corporations, and we already saw that earnings were strong, so it looks like corporate America is actually doing pretty well. It's a vast improvement. What it all boils down to is what's called the cyclical element of the economy. There are the cyclical sectors are those parts of the economy that do well when the economy is strong and do poorly when the economy is doing weakly. And these are these four elements here: car sales, inventories, housing starts, and investment in capital goods. Those are the four most prominent cyclicals in the economy. And this makes up only 20% of the overall economy, but it's very important. In fact, over the last 50 years, there have been 7 recessions, and in 100% of the cases, prior to those recessions, these 4 cyclical areas declined. The activity went down. And in 60% of those cases, when the economy recovered, 60% of the time, these 4 areas showed strength prior to that recovery. So it's very important to look at what's happening to cyclicals, and we can see that while it's about average in most of these areas, they've certainly come off of their lows in vehicle sales. Inventories are going back up. Housing starts are starting. It looks like at least they're bouncing off of the bottom and maybe moving up a little bit. And corporations are investing in equipment. So those are very good. Another good indicator. And again, you'd have to conclude from that all things being equal, this is illustrating relative strength as opposed to weakness. How about consumers? Well, this chart, or this graph, depicts the the consumer's balance sheet, and we can see a couple of very interesting things. First, you can see that that liabilities make up a very small part of your net worth. We have quite a bit of assets, consumers do, and their liabilities are a small percentage of their assets. Now, we're off of the peak. In 2007, peak assets were about $81 trillion, and the low was $65 trillion. We're back up to 78, so we're a little bit below where we were, but not far off of where we were. So again, that looks pretty good. And again, most people don't realize that liabilities are a small percentage of assets, but it actually is true. Now, on the right side, we're seeing what's happening to the amount of money we spend to pay down our debt. You can see here that we're spending much less money on our debt for 2 reasons. Number one, consumers are getting out of debt, as you'll see in a moment, and obviously interest rates are so low that it doesn't cost as much as it used to. So this is also a good indicator that consumers aren't up against a wall. They have some strength, and their balance sheets are pretty strong. Again, I wish I could say that like the government, but I can't. Okay, and then we got our bouncing arrow showing you the consumer balance sheet, and another bouncing arrow showing you how low our debt expense is. There you go. Now, consumer confidence. Consumer confidence, basically, when things are doing great, everyone gets optimistic, and when things look bad, the consumers get negative, and that's important, because when people are positive, they tend to spend more money. When people are negative, they tend to tighten the reins a little bit. But you can conclude a lot of different things from this one graph. Number one, you can see that there have been a lot of changes. We've had consumer confidence at high levels and at low levels, and we get through it. That's the takeaway. We get through it. This changes. Our confidence level shifts. So if we're, sometimes when things are great, it seems like it's going to be great forever. It's not true. Likewise, when things are doing poorly, it feels like it's going to be, in the doldrums, in the dumps forever, and that's also not true. We've survived recessions, depressions, presidential assassinations, revolutions, Cuba, earthquakes, hurricanes, you name it. And the American consumer is very, very resilient, and that's what this indicates. Also, something else I think that's important to take a look at. This arrow here, it shows basically, you see that number of 32.8, and it shows how the stock market did at the relative low point of consumer confidence. And you can see that in the 12 months following this market low, the stock market actually went up by 32%. And you can see after each low how the stock market is done. And so it might be that when things are really, really, really feeling bad, that's the exact best time to invest. Now, it's a little difficult to know exactly when that really worst point is. It's sort of like trying to catch a falling knife. And I'll show you how we resolve that issue later on. But the point I'm trying to make here is that, number one, consumer confidence shifts over time. Number two, you don't want to give in to your fear. And sometimes the best time to invest is when you're least comfortable doing so. Okay. Now, a big part of consumer confidence is made up from jobs, jobs, jobs. So clearly, many people are not working. We have currently 7.8% unemployment, which is very high. And even that number is somewhat misleading because during the recession, there were so many millions of people who lost their jobs that many stopped even looking for work. So this only shows 7.8% is of the people who want to work, how many are not actually working. And you can see over here that during the recession we lost about 9 million jobs, and since the recession ended, we've gained about 5 million jobs. So we've gained a lot. Things are not as bad as we thought they were, but we still have a long way to go. And this, according to J.P. Morgan, the economy needs to expand at 3% in order to absorb unemployment, in order to reduce the unemployment rate. And right now we're expanding at 2%, our gross domestic product, excuse me. So that probably indicates that, we're not going to see jobs get created immediately. It's going to take a very long time for people to find work. Now, unemployment is not such, one number. It doesn't really tell you the whole story. For example, clearly we've lost jobs in manufacturing. Manufacturing down at the bottom. People have lost jobs, and over the last 20 years, manufacturing has declined. But if we look up here, we can see that there have been job gains in financial and business services, healthcare, leisure, hospitality, education. There are a lot of jobs growing in those areas. So unemployment depends on really what you do for a living. It's not just a blanket statement, although granted, it's difficult right now for people to find work. Now, going back to the manufacturing, even though certainly manufacturing has contracted over the last 20 years, what many people lose sight of is the fact that America is still the world's largest manufacturer. So there still are jobs in manufacturing, just that it's been contracting. That's all. Again, not easy to swallow if you're in that area. Okay, what does the unemployment rate mean, really? Well, you have to look at who's really not working, and you can see that, for example, this bottom line shows that if you're a college graduate, your unemployment rate is about 3.8%. So it's still too high for anyone. But you can see that the people who have less than a high school degree, the unemployment rate is over 12%. So, and then as you can see to the right, obviously earnings follow. The higher educated you are, the more income you have. But the takeaway here is that to really get a sense of what's happening in our economy, you don't look at just the unemployment number, but also look at what's happening in the different areas of the economy. Certainly, even if you look at the college-educated people or people with some college, unemployment is higher than what it's been in the past. As a matter of fact, unemployment among college grads is about double where it was in the year 2000, but still it's relatively low. And I just think that that's, helps you have a better understanding of really what's happening in our economy. Okay, let's shift over and look at real estate. So by any stretch of the imagination, we'd have to agree that real estate prices have been getting stronger. They've been increasing. You can see here, these are 3 different indices that look at the housing prices, and they've gone up. Certainly not to the levels of 06 and 07, but the prices looks like they've been bouncing around the bottom and coming back up. Now, excuse me, here we go. Fancy arrows. Now, there we go. This next slide, I think, or where this arrow is pointing, is really helpful to understand real estate. We see here a comparison between the cost of renting versus the cost of owning property. And you can see that up until about 2004, 2005, it was about the same. Then housing prices went through the roof, and it was much more expensive to own than rent. And now it's gone the other way, where it's more expensive to rent than it is to own. And what that indicates to me is that since rent is probably not going to go down, it probably means that the value or real estate prices dropped a little bit too far, and they're probably going to come back up. So what it looks like to me is that there's going to be a recovery in housing, and it's going to actually absolutely help fuel the recovery. It may take a while for the economy to recover, but certainly it's acting as an additive. It's acting as an additive and helpful rather than a drag on the economy, which is what it was doing up until, let's say, very recently, the last year. Now, home inventories are very important as well, and we can see that inventories are pretty low. This is important because the more inventory you have, the lower the prices are. And here we don't have very much inventory. But that's a little bit misleading because banks who have taken back real estate aren't dumping all of their real estate at the same time. They are holding back to keep the prices up a little bit. But assuming they will continue to do so, the chances are good that real estate prices are probably on a recovery mode instead of a continual spiral down. Now let's look at energy, because up until now energy has been a problem, right? The higher the price of a barrel of oil, it was sort of like a tax on the American consumer because the money just gets shipped out overseas and doesn't provide any benefit for our economy. So let's take a look at net imports of our energy, and we can see here quite clearly that our imports are going down. We're importing less fuel. And the reason for that is, number one, we're much more efficient, and number two, we're using technological advances such as fracking, and these types of technology are going to continue to come online, continue to provide more energy sources. We're going to continue to be more efficient, and that's going to reduce our net imports, and that's a great thing for our economy. So that's a positive. What about banks and lending? How are they doing? Well, if we look at the first chart on the top left, lending standards have increased. That means banks are demanding that people who get loans can only get loans if they have a higher credit score, FICO score. And the reason that that's important to you is because now when your neighbor sells their home to someone, you have a much higher comfort level knowing that that person is not going to default on their loan and they're not going to get foreclosed on, and it's not going to bring the value of your home down. When we look at delinquency rates, that's been stubbornly high when you look at mortgages, but at least it's not getting worse. So our delinquency rate has gone way up, and it's not come down very much on home mortgages, but at least it's not getting worse. But this is a troublesome sign. This might be one reason why the banks haven't dumped more property on the market. And it might be a reason why they're allowing people who are in trouble a little bit more leniency. So that's something that we've got to continue to watch, is that delinquency rate. That's a very important indicator going forward. And that's something that really can't be manipulated as easily. So it's important. Okay. Now, regardless, the equity of banks, the net equity, is higher than it ever has been, or has been in a very long time. What that means is banks are very, very solvent, and that's very important because back in 2008 we had a lot of fear about the American financial system basically folding up and going away. It looks like the banking system is stronger than it has been in many, many years. So that's an encouraging sign. Now, my arrow's gone for some reason. Okay, if we look at the United States, we can see that our net exports are a pretty small percentage. It's about 9.8% of our overall GDP. And what that means is that we're somewhat insulated. We're not that dependent on the world for our economy to continue to expand. Germany, on the other hand, almost 40% of their GDP depends on exports. So as a result of that, it looks to me like our economy is pretty strong and isolated. And if anything, the other countries of the world depend on us. Companies that really depend on us being a very, very strong economy. They have a vested interest. The outside world has a much stronger interest in us being strong. And although obviously it's going to be helpful to our economy if there's a strong world economy, but we're much less vulnerable than many other countries. And now we've got this fancy thing going away, and there's the arrow that's in the wrong place. Okay, good. Are we in a recession? Well, recession is identified or defined as two consecutive quarters where the GDP declines. And we had a very bad recession, but as you can see to the right of that blue arrow, our economy has been expanding. Not only has it been in recovery mode, but it's actually expanding. And it's been expanding for a very long time. Now, the biggest driver of our economy is consumption. It's not, the government's a very important part of our economy, but the consumers are a much bigger part of our economy. And you can see that that's surprising. We think that the government runs the whole economy. Now, it's not true. Consumers do. But obviously, 20% of the slice of economy that's contributed by the government makes a huge impact on our expansion or contraction. Okay. Now, are stocks or bonds a better value? If we've already agreed that the economy, and we'll get to the government in just a bit, but if we've already agreed that the government is, the economy looks strong, corporations look strong, consumers look strong, what's better to own, stocks or bonds? Well, this green line shows the S&P earnings yield, not the dividend, but the earnings, what these companies are earning. And the gray line indicates what the BAA bond yields are, and we use BAA because that's the average credit rating of an S&P company. And we can see that bonds since 2010 have yielded much less than what people who own stocks are earning on their equity. But where is the smart going? Where is the smart money going? Well, you can see here the blue line represents what's been happening with bonds. Money has been pouring into bonds since 2009. And that's understandable because in 2008 and the beginning of 2009, people were scared out of their minds. And as a result of that, they poured their money, they took it out of equity and put it into bonds instead. The question is, and you'll see, in fact, the only time, there was a short time in 2010 when there was more money going into equity than there have been in bonds. But here's the question. Is that the smart way to go? Well, as you already know, and as interest rates go up, the value of a bond will usually decline. And interest rates are so low right now that it doesn't look like there's any place for them to fall. So that means they're going to either stay stable or interest rates will go up. And if that happens, the value of those bond investments are going to decline. So even though there's been a ton of money, piling in to bonds, it's probably not a good place. And that's why I recommend shorter term bonds, intermediate term bonds, and also possibly balanced funds so that you don't have the exposure to long-term bonds. Now, are CDs the alternative? Well, let's take a look. Right now, if you invest $100,000 in a CD, you might get $450 of interest over a year. So that is almost laughable. You can't grow your financial security by investing in bonds. It's not to say that, in CDs. It's not to say that you shouldn't have money in CDs, because sometimes the liquidity is important. But the interest rate is terrible. And maybe a few years ago, in 2006, it made sense to own a CD because you could get $5,000, $5,240 on a $100,000 investment. But now it's less than 1/10 of that. So the interest is so bad that it really doesn't seem like a good place and a good alternative. Now, this blue line shows what's been happening to the amount of money that's been invested in CDs, and you can see that it's been rising. It's a pretty high number. A lot of cash in CDs. And again, that's been basically at the very low point of the market where there's a crescendo of deposits into the bank. And you can see that that's probably the very worst time. People generally, you'll see an increase or a topping of money rushing into banks at exactly the worst time. So it doesn't look like the banks are a great place long-term to invest for your financial future. Now, how's the government doing it? Doing as well as the private sector? Not so much. As you can see, unfortunately, for every dollar the government spends, 32 cents comes from borrowing. And that's really, really a scary thing. If we look at the chasm between what we bring in, which is the gray line, versus what is spent, you can see that the difference between those two has never been greater. Now, this is not a political issue. This is an economic issue. And that simply cannot continue because the government is spending more than it's bringing in. It creates a lot of uncertainty because companies don't know if their taxes will go up, and consumers don't know if taxes will go up, will they have money to spend or not? If taxes go up, will they lose their job because corporations won't have enough money? Will there be a contraction of the economy? So, for all these reasons, a huge difference between, or a deficit between what the government takes in versus what they spend is a big drag on the economy. And you can only imagine that if, in fact, the government budget was balanced, that the economy would really be screaming, would really be doing quite well. Now, we can see, to be completely frank, that over the last 40 years, almost 50 years, the government's been spending more than it's been bringing in. Just that right now it's at an extremely high level that does not bode well. and you'll see how we deal with that in just a few more minutes. Now, it's still important to get perspective. Is the United States another Greece waiting to happen? This is not what my napkin looks like after I spill coffee on it. This shows debt as a percentage of, the cost of debt by the size of the little dot. So the bigger the dot, the more expensive, the more money is spent financing the debt. And the lower it is on the right side, it means it's a bigger percentage of our GDP. So the more it is to the right, like Greece has a very high percentage of its assets. There's a high cost of the debt, number one. Number two, the GDP growth has been negative. And number three, we can see that it's a high percentage of the GDP. So that's really bad situation. But the United States, on the other hand, our dot is small. And what that means is that our cost of debt is pretty low. Why is that? Because interest rates are so low. That's why. So relatively speaking, our costs are low. Number two, we still have a positive growth. We have a growth rate that's going up. We're not contracting like Greece. And number three, while we have a high percentage of our GDP in debt, it's not at the extreme levels that Greece or even some European countries have. So relatively speaking, it's not the end of the world. We're relatively speaking doing much better than a lot of countries. But it's certainly something to continue to be aware of and to pay attention to, and that's what I do. Now, there are four different scenarios when it comes to being an investor. Number one, high and rising inflation. Number two, high and falling inflation. Number three, low and rising inflation. The inflation is low and it's going up. And then fourth, low and falling inflation. Right now, which quadrant would you say that we're in? If you said low and rising inflation, you're right. That's about where we are. Well, inflation isn't rising yet. Well, it depends on if you use the government numbers or other figures. But certainly, we have low inflation now, and it's either stable or going up. And this shows you what the best investments were during periods like that. So you can see, historically speaking, during low and rising inflation, equity investments do pretty much better than everything else. So that's another reason why it's probably a good time to focus on equity as opposed to bonds, cash, or commodities potentially. But if we have falling inflation, then you're going to have a lower commodity prices. So equities is probably the safest place to be, at least given the historical standpoint, from a historical standpoint. What do we expect in 2013? Well, obviously, I can't tell you exactly. And no matter how good things look, you can see on the left side that in any one year, the market could do very, very well or very poorly. We can see this green line shows you equities. And in its best year, in 1 year, it made 51%. In its worst year, it was down 37%. So there's a lot of volatility, and the band is very wide if you just look at a 1 year perspective. If you go out and look at a 5 or 10 year perspective, the band gets very narrow. So if we look at a 10 year perspective, for example, the best 10-year average was a positive 19, and the worst was a negative 1. And if you look over to the portfolio of 50-50, then from a 10-year standpoint, the best 10-year average was a 17% return, which is very high, and the worst was a negative. Was a positive 2. So you can see that when the longer you go out, the better your returns look, and the more narrow the volatility is. So what this indicates is that if you have a 5, 10, or longer time frame with your investments, it probably makes sense to have something like a 50-50 portfolio, anywhere between a 50-50 portfolio to 100%. I like the 50-50 portfolio because the returns are not that much higher on the stocks than the full stock portfolio, and the downside in any 1 year is much less on the 50-50 portfolio. But that's a general conversation. It would depend on your own situation, specific to you, what your needs are. Your needs are for income and your age at this time too, and your risk tolerance level. So generally speaking, a 50-50 portfolio is a pretty good mix if you've got a 5 to 10 year horizon. We've seen that consumers are actually doing pretty well. We as consumers, we don't have that much debt. Our debt expense is low. We've got a really strong balance sheet. So that's wonderful. Number two, corporations have more cash on hand, less debt, and also a lower debt expense. Plus, earnings seem to be going in the right place. So that's a very positive direction as well. Government is the big question mark. The situation isn't that great, and it's not going in the right direction. Hopefully, the government will get its act together and find a way to reduce the deficit, because over the long run, that's not going to be a positive, but it will detract from the ability of our economy to expand with jobs and profits and wealth for the people who live here. Now, given all this uncertainty, what's the best strategy? Well, number one, you want to be clear about your own needs, your own financial needs. Do you need income? Do you need capital? When do you need either the capital or the income? What's your time frame with the money? What are you spending? You want to be clear on a plan and what your needs are now and in the future. And that's what a financial plan does, and that's what I do for my clients as well. The second thing is be aware of your alternatives. And we've looked at a number of alternatives today, the pros and cons of each. And of course, there's no certainty anytime you invest, but we've looked at some of the pros and cons of the alternatives, and I think you can draw your own conclusions of what makes most sense. But number three, always very important to be vigilant, because the stock market changes, the economy changes, and one strategy does not fit all. Your own situations change over time as well. So it's very important to have in my opinion, to have an investment strategy and a financial planning strategy that is dynamic and vigilant, because things change. Now, I want to thank you for taking the time for the people who came to the workshop. Thank you for coming, and for the people who were watching this on YouTube, I really appreciate that as well. Thank you. And it means a lot to me personally, to my family, and to the people who work with me, that we're able to be of service. So I really do appreciate that. And I want to share with you quickly what my 7-point client delight game plan looks like for this year and going forward. Number one, continue to pay attention both to the market and obviously allow the market to guide the investment decisions, and that's worked out really well. Of course, there's no guarantee of the future. But more important, to pay attention to you. What's going on in your life? What do you need? What are your greatest challenges? What are your obstacles? How can we go around that? How can we resolve the issues? Pay attention to you. Very important. Number two, a flat hierarchy. In my company, I know everything that's going on with any service issue that has to do with a client. So nothing falls through the cracks. And that's something that large brokerage firms can't really say, because there's such deep hierarchy that things get messed up and ignored all the time, and that does not happen here. Number three, 15-point quality control. Everything that we do in our company, we have a checklist for. That way, again, it's very important to me. I hate it when something falls through the cracks for me, and I don't want it to happen in my company. So that doesn't happen because we have a 15-point control quality control system, at least 15 points. 97% of my clients are referred, and 98% of the people who come on board stay here. And that's important for clients, because I've got a lot at stake by delivering results on an investment side and on a service side. Now, obviously, I can't guarantee either, but it's very important to me, and because a lot of most of the clients are referred and a vast majority stay, well, we must be doing something right. So we want to continue that and pay attention to that. Next, I write for a number of high-profile mainstream media publications, Huffington Post, Yahoo News, or Business Insider, etc., Forbes, and I've been interviewed in the Journal a number of times as well. And the reason that that's important to you is that, number one, I've got to stay on top of what's happening. I can't just go play golf. I don't even know how to play golf. So I've got to stay on top of what's going on in the market and in the economy and in the financial planning world, because I'm writing so much about it, and that's beneficial to people I talk to and people I work with, because number one, I'm more aware of what's going on. I'm doing a lot more research than otherwise would. And number two, I make that information available. So I'm writing 4 times a week for my own blog and several times a month for other publications, and clients tend to like that. But the most important delight game plan for me, or of the 7 points, the most important is 98% of my clients who want to stay retired, stay retired. And I think that's a critical success factor that I'm especially proud of. That when a client shares with me their financial goals and we agree that they're doable, I try to move heaven and earth to make sure that it can happen, and it stays that way. So that's why I do what I do, and that's why, quite frankly, I feel successful in what I do, and why I hope to continue doing it for a long, long time. Number one, paying attention to what's going on with you, with the market, and my business. So I want to thank you very much for attending and for listening to this workshop. If you have any questions, please connect with me either on my website or on Facebook or Twitter. If you have any questions that I can assist with, please give me a call. Again, thank you, and I wish you nothing but health, success, and well-being. Thank you.